You are watching Notepad. I'm your host, Ibrahim Sani. Very quickly, before we started this interview, a producer of mine reminded me that we're less than 100 days heading into 2021. So with less than 100 days to go, we have to do a quick stock check into how 2020 has performed for the country in terms of the world of investment and business, but also keep a close eye into how 2021 would look like. And because of this, there's a lot of talk about how the country is putting its money, how businesses are coming back and reigniting their commercial activities. So because of this, we want to have a chat with one of the bigger asset managers in the country. One of them is, of course, Principal Asset Management Berhad. Joining me is Munirah Khairuddin, the CEO of that company. Munirah, thanks for coming back to the show. Let's go through into how 2020 has been for you guys for this year.
It's been, thank you, Ibrahim, for having me on the show. I think 2020, like most of us, has been quite a strange year, an exciting year. I think post-COVID, we're seeing, obviously you've seen the markets have rebounded very healthily, but I think we are more comforted that global supply chain is coming back in. So one of the indicators that we monitor quite tightly is the Purchases Managers Index. So the PMI globally is now sustainably above 50 mark. So if above 50 points, then it gives us a predictive, a leading indicator that economies globally are actually expanding. So I think China has had its 6 months already of PMI being very steady. So those kind of growth indicators is obviously very comforting to markets and to the economy. It gives a real signal that we're at a nascent recovery, but if you can imagine if economies do open up more, then that recovery could be more sustainable.
But we cannot ignore the fact that the compression of GDP is anywhere between -9% to -2% based on a lot of consensus. Some estimates put it as even below that, double-digit negatives. Second quarter GDP growth is actually quite really bad, to be frank. How does this pair with that PMI view that you have? Because watching the PMI is a good idea, but at the end of the day, people still look at the GDP growth, and in the sense, it's negative growth for this year. How do you reconcile that kind of?
Yeah, it's a bit of mixed signals. So if you've been following the U.S. and the Fed, they came out with a statement say that it's going to be a while till the U.S. economy does recover, and so that is kind of. People take a step back, and even locally, we think Bank Negara will probably not, cut rates anymore, not hike rates, but and a moratorium will be targeted to be extended. So those are kind of like mixed signals in the economy. But I think where we're looking at is, the economy is flushed because globally, most central banks' monetary policy has been very, very easy. And lots of fiscal stimulus coming up, right? And so while growth may be patchy and still not quite certain, but certain sectors of the economy is leading that, right? So in Malaysia, as you know, the healthcare stocks, and you see tech, you see plantation, and the good thing is, I think, after that, we are hoping for a more broad-based consumer discretionary type of sectors to come in and support. So it's like a initial stage of recovery, and I think this is very good for capital markets actually.
Okay, we'll talk about the capital markets very shortly, but right now let's focus on the idea of the government wants people to spend a little bit more. Savings, however, is on top of people's mind as well, because at the end of the day, it's all about the food on the table that they have to think about. This whole split view between spending and saving, of course, is another topic that we tend to focus on when it comes to times like this. What's your view on the situation right now?
I think that's a typical struggle of most economies, whether developed or developing economies. Right now, the situation is quite flush actually. There's a lot of money looking for home. But having said that, whether it's trickling down, so the poorer ones are getting hit, and even some of the middle income. But so I think, it's 50-50. You still get, the bulk of the, consumers still struggling. But on the other hand, in Malaysia, for example, with this moratorium, right, people are still flush with, their take back pay home is now a lot more eased, right? And that's why we see participation in local stock markets, for example, right, or even our unit trust funds. So we see that coming through. SMEs, we still hard to see whether SMEs will continue to survive or struggle. So it's very selective depending on what sectors you're in.
Yeah, let's fall back to Principal Asset Management
Yeah.
right now. Have you changed your investment strategy after MCO, or are you still heading home with the same strategy that you've deployed earlier in the year?
Oh, we've had a couple of changes in strategies. When we went into MCO, we looked into liquidity, right? Whether there'll be a pullback in liquidity, and so we were a bit more cautious, right? And then we were quick to deploy back to the market. So we've had a couple of changes in strategy, and going back to the market, not just because of valuation, but because I think there's really some good signs of earnings revision. Right, so we've changed our strategy. We're now
All downwards, by the way.
Huh?
Like, all the earnings revision that you speak of, it's actually lower than expected.
lower than expected, but then again, fund managers like ourselves, we're stock pickers.
Yeah.
So it's still not so broad based. So certain stocks, certain sectors, right? If you like, so smart investors will look for that kind of valuation.
Yeah.
So we talk about foreign flows into our markets, for example. I think going forward, people are going to be very selective, right? It's not going to be broad based across the whole, economy or markets.
So does this mean that comprehensive investment style like REITs or ETFs is a big deal for consumers these days?
I think you gotta. My general advice is always have a very diversified portfolio.
Okay.
Right, but if you do have, if you're an aggressive investor and you do have, spare change to kind of be more concentrated, then I would go a bit more aggressive, on some of the equity themes. So we like equities. Better than fixed income. Fixed income has had a good rally,
Yeah.
but that's just going to go sideways.
Of course.
Yeah. So I think overall you could see the real economy. It's still unclear how that's going to pan out, but we're starting to see good signs of recovery. Whether it's going to be broad based or not, we got to watch that. And market certainly has been also nascent recovery and strong. So I think those are indications that I think we're not too bad.
Okay, compared to other markets, you mean?
Yeah.
All right, let's focus a little bit more on corporate earnings. The big guys are normally there to carry the market, but it seems like some sectors are in a state of flux. So for example, banks, they don't know how to price their NPL right now, not until people are supposed to start paying back. Some of the risk managers that I spoke to in recent months, they have projected a few models, but they qualify it with saying that these are just literally models. We don't know how well people pay back because the moratorium has not been lifted. Now that it has been lifted for the most of us, then we can see a better assessment towards how they manage their risk. That's just, say for instance, the financial industry. But there's also other sectors where they borrow and now they have to pay. And the question is, how will they do that in such trying times? All this impact into how their earnings are going to look like for 2021. And as we mentioned just now, there is a earnings revision. There's also the fact that all of these revision towards their earnings is actually downtrending. Do you see this as really a problematic time for you as an investor to put your money and, I guess, find value where it lies? Is this going to be a tough time for you guys?
Yeah, so to that keyword on value, right? So if you look into the banking sector, it's below book value, right? So valuations are very attractive. And so when the economy starts to recover, usually the banking sector will recover. So the inability to do their pricing models, etc., obviously, is a limitation to banks. But I think as the economy recovers, you cannot not be in banks, especially at such, attractive valuation. So I think that will come through when you start to see a more broad-based recovery. So the question is whether there will be a broad-based recovery.
This ties in closely with the National Healthcare Plan. and also how COVID is going to come back in terms of with a vaccine or without a vaccine, because you can't talk about the world of investment without public healthcare. There has to be a worst case scenario, right, for you guys at least. If there's no vaccine the next, I don't know, 12 months, how would you perform? If there's a vaccine, how soon will we get it, and how does that react into how you do your business? What's your contingency plan in terms of managing your business in relation to public healthcare?
I think the headwind is obviously the healthcare, not to mention stuff that's happening in the US, elections, etc. But we're optimistic that the vaccine will come through next year. But whether the rest of the world will get to enjoy the vaccine or not, so I think we could be well into second half into next year, if anything, on the vaccine and then recovery, etc. But I think people are starting to live with the new norm. So as I mentioned, smart money is looking for really, good buys, right? So I think my view is that is a great time to be picking stocks, to be honest, right? Some form of correction is healthy, because then we really get to assess whether these kind of companies are here for the long term. Right? Because this kind of volatility, this kind of uncertainty will continue. So really, the best people will win.
All right.
Yeah.
Okay. We'll take a short break before continuing our
Sure.
conversation with Principal Asset Management. Don't go anywhere. Thanks for staying on with us. I have with me Munirah Khairuddin, the CEO of Principal Asset Management. Let's talk a little bit more about the digitalization trends and insights. We've relied over the past few years towards AI, towards relying more on automation. Do you think that this will take hold into such businesses like yourself, an asset manager that relies a lot on, say, robo-advisory, for instance? Do you think that now's the time to start relying on robots, less on humans? What's your view?
So we've been, very stalwart asset, stock pickers, right? But the way, the investment world has changed is that we're using a lot more data and a lot more digital tools to help us make faster decisions. So in terms of research, right, we use a lot of data to try and decipher what is the next predictive trend. So that's one. In terms of robo-advisory, what robo does is it breaks down, the complexity or the black box of investing into very simple goals for investors. That doesn't mean that behind that it's not complex, So behind that, our asset allocation tools, etc. So we're increasingly using a lot of that. And I think I'm very bullish on, robo-advisory, simple goals, etc., especially for, for rising middle income. Right, and so guys like ourselves, very rapid rise in middle income. People want to have simple portfolios rather than cracking their heads. Where
less
to
is
invest.
more, basically. Yeah.
Less is more.
Yeah.
So I'm a big proponent of AI, robo, and digitization. But I don't think that put active asset managers like ourselves out of job, basically. So I still believe that digital plus human, I think it's going to be a stronger combination.
I asked the same question to other fund managers. For instance, Tang Chi Wai of Afin. He said that he misses the days when he was a young broker, young investor, when he actually went into these kind of businesses to look for value. Drove into the plantations to speak to some of the companies that have just been listed, for instance. Some mills, either palm oil businesses or sawmill or whatever, right? And he says that these days he doesn't have the luxury to do that kind of thing because, size is bigger now and stuff like that. That's his story. But at the same time, there are a few other people that I speak to. For instance, Stashaway and Wahid Invest, and they don't meet the people that they invest, because everything is packaged in a bundle, and they don't even invest locally, right? That is the shift of the old school versus new way of thinking. And when you meet new retail investors, people like me, right? We are not pressed for finding that value from that specific business owner and that kind of stuff. We just want to plonk our money in, and if you can give us something like whatever 3%, 5% per year, we're very happy with that. Does the consumer behavior push the way you do your business moving forward? Because it's less of the people that are in the 50s and 60s, there are more people, young, 20, 30s, that are entering the world of investing. Still, I'm talking about retail investors, not like your guys there. Do you feel that because of the consumer behavior changes, the way they want, say, unit trust products or whatever other products that you guys have, might force you to change the way you do your thing?
I think it's not might force. We're already changing the way we do things, and we'll probably be able to announce some exciting proposition.
Announce it lah. This is the best place
very
to
soon we'll announce it. We'll keep it very. I'll definitely have you there. But I think, Ibrahim, when we look at it, right, we are very, very methodical and cognizant of the market segments that we're trying to serve. Okay, so with the rising middle income, the middle segment, right, like yourselves and like many other early adopters are looking for something simple, consistent, and so we need to serve them, right? Whether it's active investment or whether it's robo-advisory, we got to serve them. But on the higher end, right, there are many more Malaysians that are entering into high income brackets. And I can tell you that the appetite there has evolved too. So stuff like more more bespoke, like real estate, even to a certain extent private equity, etc. So we've seen like a plethora of many value propositions depending on the markets. But retail investors, I think for sure we need to serve the retail investors more simply. And I think simple goals based is here to stay, I think.
Okay, right. Let's talk a little bit more about retirement. Last Sunday, I celebrated my father-in-law's retirement. That was bizarre for me because I don't see him as a retiree, but that is a psychological step that I have to take, but he's enjoying retirement. This is day number 4 of his retirement, and of course he's a former government servant. He's going to enjoy pension until he dies, and then that whole question of how the country is managing pension fund is a big topic. We've spoken about this a long time ago. We're continuing to speak about this right now. It's not sustainable, and of course folks like Kuap, for instance, are going through a whole renaissance, I guess, on how they view how they serve the people. Because of this, do you feel that there is an urgency of the government? See, I'm putting you in the spot right now. But do you feel that there is an urgency of the government to re-look at how pension is being done in the country, and perhaps people like you can come in and fill that kind of vacuum?
I think let's establish two main important facts. Number one, income replacement ratio in Malaysia is about 35%. Meaning, if you at your point of retire earn say 10,000, right, you need about, actually IMF recommends 70% of that to sustain you. So you need 7,000. But really today it's about 3,500. So imagine if your last income drawn when you retire is 5,000, 3,000, 2,000. So we are far away, half away from income replacement ratios that we need to be. Fact number one. Fact number two is that Malaysia will enter an aging society by 2030. That's technically like 9 years and 3 months to go.
Yes.
Right. So definition of aging society is if more than 15% of your workforce is in retirement, and we are fast approaching that. So those two facts, right, and combined with the fact that you've read all those articles about your mandatory pension, your EPF not being enough, right? So the facts are quite jarring that Malaysia is not ready for a comfortable retirement.
You are scaring me like anything.
That's
right
true.
now. Right.
And rising healthcare is another factor. Not enough insurance going around to broad-based population. So a combination of that, rising fiscal deficit on the government part.
How do we solve this? Being more active in terms of investing.
So
we
you
can't
need-
deal with
Correct.
passive investing anymore.
So
Of course, there has to be an element.
Yeah. So we call this the era of personal responsibility. That you need to, move away from this thinking of a subsidy given to you by the government because you pay tax. let's be clear. I think we have 1.5, 2 million taxpayers against a 31 million population. So, I like to talk
Hisham
about...
of EPF called this a club sandwich economy.
Yes, correct. It's
not even a sandwich, not even a sandwich,
club.
but a club sandwich economy.
Yeah, yeah. So we're a club because we've got
yeah,
retirement,
yeah.
parents in retirement, and we've got young children. And I don't know if you noticed, but we're working really hard these days.
Oh, yeah.
Yeah. So it's an era of personal responsibility, Ibrahim, right?
All right.
And so the solution is that you need to complement that with your other voluntary savings. You have to, and it has to be done with discipline, right? There's lots of research and statistics have shown if you don't have that discipline, the tendency to claw into that jar of cookies and savings is very, very high. So
Yeah.
you really need to put it away.
Because, I mean, let's be frank about the whole situation here. I mean, already Malaysians are not earning enough in terms
Correct.
of wages. So whatever that comes into their take-home pay, they tend to pay for everything that is pressing today, not necessarily the thing that you would imagine
You
they need 30
spend,
years ago.
finish your expenses, and then, oh, okay, I have a little bit more. Should I save, or maybe not? I think I deserve a new
like a treat, yeah.
trade or
Yeah.
something.
But that's
So the key to that is methodical savings. And, like for example, EPF has done really, really well. Why? Because every month our money has been deducted and put away, stashed away in a very, safe environment, and then that compounds and accumulate.
yeah,
right?
but EPF also has their own headache because the money that comes in is billions per month, and they have to find assets to invest in.
But my advice always is that, your mandatory pension has really benefited by that regular savings. You need other forms of regular saving. I'm not meant to push any product or whatever, but, private retirement scheme, unit trust funds, or whatever form of savings, right? You've got to put that aside and do that on a monthly basis. We've got, over 300 companies on payroll with us on deduction for the PRS.
Right.
So every month deduct $100 and you won't even notice it.
Yeah.
But after long periods of 20 years in employment, you'll thank yourself for doing that first step.
All right. Okay, we'll take one more short break before we
Sure.
conclude our conversation with Munirah Khairuddin of Principal Asset Management. Don't go anywhere. Thanks for staying on with us. I have with me Munirah Khairuddin of Principal Asset Management. We have to conclude this conversation. Let's bring about the outlook of 2021. How do you think the world will look like 100 days from now?
100 days from now, I'm hoping that the US election will turn out well. And I think China will continue to recover well, and Asia will continue to benefit from structural changes in the supply chain. I think Malaysia should do well, right? We do have some, even if you look into the sectors of the future, like healthcare, technology, commodities. So we are rightly placed. So I'm hopeful that there will be more broad-based recovery, and the indications are there. And so I think 100 days from now, I'm hopeful that, we will be in a better place broadly.
All right, from your business point of view, how are you future-proofing yourself for 2021 moving forward?
For sure, we are putting in a lot of resources in our digital plans. And I believe in the rising middle income, as we were talking about earlier. And I think the power of micro-investment, digitally connected and digitally served is the future for investors.
All right, thank you very much. That was my conversation with Munirah Khairuddin of Principal Asset Management. If you've missed any part of this interview, just head on to astroawani.com, look for Notepad over there. You can also watch these kind of interviews on your mobile devices. Just download the Astro AWANI app, wherever you get the application. Till then, thanks very much for watching, and goodbye.
Thank you, Ibrahim.